Diwali is round the corner and I have a very special guest today to gauge how Samvat 2080 may pan out for us. I have with me Vetri Subramaniam, CIO of UTI Mutual Fund, the fund which manages, 2.7 to 3 lakh crore rupees of assets. Vetri must have seen over 25 samvats in his stock market innings. So welcome, Vetri, to this special samvat or pre-samvat conversation. Well, first up, 2079 has been a little rocky, actually. The Nifty touched 17,000 and 20,000 plus. So do you think we will have 2080 also as a rocky one?
Well, first of all, Latha, delighted to be here. I wish all our viewers, your viewers, a very happy Diwali. It's always lovely to connect during the festive season, and we also get to show off our festive attire. So
yes.
I think I would really not look just at the short-term range this year, but to really say that the market, and when I say market, I'm referring to the large caps, have really not made much progress over the last 2 years, Latha. If you look at the last 2 years, the CAGR on the Nifty 50 is in the region of about 3% or 3.5% CAGR over the last 2 years. And if I were to sort of pick one of the reasons for this, it would actually be that the starting valuations in September, October of 2021 were very elevated. So even though 22 was a great year for earnings growth, 23 a decent year for earnings growth, the market has sort of not done much in terms of price because it has used this growth in earnings as an opportunity to start to normalize the valuations prevailing in the marketplace. However, this is largely true for the Nifty 50, the Nifty 100, so more large caps, not so true for the mid caps and small caps, but I'm sure we'll talk about that later. Finally, if you look at the Nifty 50 valuations, we are still above the long-term average, but the good news is that compared to being in the expensive zone 2 years ago, we are now back somewhere within the comfort zone, slightly above the long-term average, but certainly within the comfort zone.
Okay, then let me stick with valuations before I come to the mid-cap argument. Can we continue with slightly elevated valuations because we seem to be the only growth story in town? Will FPIs allow us that higher valuations and still come and bite?
Well, Latha, I won't claim again that I have a crystal ball to understand what FPIs might be looking at. Now, we talk to a lot of foreign investors also because we manage money for them. And the point that I would make is that certainly the interest level is very, very high. But, it's not just a function of which market offers you growth, Latha. It's also a question of, are you getting reasonable sort of margin of safety in terms of the valuations at which you're buying equities. I think any equity investor, whether he or she be local or institutional or whether it be global, margin of safety is a universal concept. And again, while we can talk a lot more about it, I would say even this year in terms of foreign flows has been volatile. And one of the reasons for that is that, remember, the rising US yield is now acting as a magnet for global asset allocators thinking about the long term, because for the first time in more than a decade, Latha, they are getting a reasonable return on their debt investments. And therefore, in that context, you need to remember, India may be very attractive relative to many other EMs. It may stand out relative to the DMs, no doubt. But the bigger argument, what's the global rebalancing going to happen between debt and equity? Because it's been a one-way trade in terms of a hunt for yield over the last 12 to 13 years. So India stands out within the equity basket, but what about the allocation to the equity basket? If that is going to crunch, we'll have to see how that balance plays.
Okay, what's your sense about domestic flows? I mean, the domestic prosperity is just hitting you. You can see that in tax collections, as well, the amount of money that's coming into the financialization of savings. Won't that be a good buffer and continue to keep valuations, slightly above the long term simply because there's more money?
So you're right. This could certainly be a factor in the short term, but I think in the longer term, interest rates work like gravity, and therefore, you can't permanently and for a very long period of time defy the forces of gravity that interest rate provide to valuation. I think yes, domestic money flows have been very, very robust. That certainly helped the market. That also explains, perhaps to some extent, why mid and small cap performance has been much stronger than what we've seen in large caps over the past 2 years. But, Latha, the key sort of thing to look at over here is that have you brought forward returns from the future into the present, because money flow has been very, very strong. And also, as regards the prosperity line, it's still early days, Latha, but we've talked about the K-shaped recovery in the past. High-end consumption is doing well, low-end consumption not so great. Nothing has changed in this picture over the last 2 years. And when I see the results coming out for the for the quarter that went by, I think we are seeing more and more issues in the consumption side in terms of the underlying strength of the growth metrics, including in what have typically been sort of more mid to high end. There is some sense of more a steady state coming into growth over there. And, I think you've done programs about it in terms of the rise of indebtedness and the fall in savings. So I would be a little careful about, getting carried away with the strength of domestic flows. The momentum is very, very good, but it's not clear to me that all is well with the household sector to be able to generalize that.
Okay. No, that's a very important observation. I would have expected that from an economist, definitely. But
we are seeing it in the company numbers, Latha, that there is certainly a consumer slowdown which we are seeing relative to the past trend. That's about it.
Okay, that which brings me to the sectors. I mean, we saw banking and finance be the flagship. Do you think now margins and worries over unsecured debt will bring that down? What do you see as the new leadership sectors?
Well, I hate to predict leadership because the market will do exactly what it chooses to do. I prefer to look at where I see opportunity. Not much has changed in terms of where we are sort of seeing opportunity over the last 5-6 months, I would say pretty much year to date. I think where we've been most excited has been healthcare and pharmaceutical, where we think the area is a bit contrarian. It's not suffered some of the valuation excesses that other areas have gone through in recent times. A lot of the companies are sort of cleaning up their balance sheets, and that's a good time to look at those businesses. So that's an area we like. The banks you talked about, we certainly like that area. It's no longer cheap on an absolute basis, but I'd say mid-cycle valuations, consolidated lending sector, continued growth, we continue to like that area. Auto, I think, is still mid-cycle as well. Car sales have recovered to their 2019 peak. In fact, they will surpass the 2019 peak this year. Commercial vehicles will maybe surpass the previous peak next year. Two-wheeler sales still running 20% below the previous peak. The festival season strangely seems to have, or rather from my point of view, good news. We are seeing a lot of strength in two-wheelers. So I think in autos as well, we think mid-cycle, good growth prospects, good prospects for margin expansion in some portion of the automobile sector as capacity utilization picks up. So these are the three areas where we feel a lot more comfortable. Capital goods, engineering is where we feel slightly more reticent, because I think over there the valuations and what's factored into those valuations in terms of implied growth, in our opinion, now pretty much captures any opportunity over the next few years.
Okay, but there is an additional fear that the government's capex cannot continue like this. I mean, the finance minister herself has said that fiscal deficit has to come down. So, that could be another dampener for that sector. But before that, this theme on mid-caps versus large caps, are you still very worried about mid-cap valuations, or are these pockets and the high growth will still come from there? If yes, which part of mid-caps will you watch?
So to be fair, one, when you break down any aggregate number, whether you break down large cap, mid cap, or small cap, look, there will always be some part of it which still looks reasonably attractive. There is some part of it which will always look costly. This was true even, Latha, in 2000, when I saw all the IT companies go through the roof. They were super expensive. The market was expensive, but you could have bought a hell of a lot of consumer companies, metal companies, dirt cheap. So dichotomy in valuations is nothing unusual. You always see dichotomy in valuations between sectors, but aggregate market valuations being expensive suggests that that is the level of implied growth that the market has already factored in. And then what you lose as an investor is margin of safety. So to my mind, when I look at the mid and small caps today and their valuations, they are sorely missing margin of safety. And to my mind, that is an unacceptable risk. Now, others might feel differently, but to my mind, this is an unacceptable, loss of margin of safety that, doesn't give me too much comfort. And finally, from a valuation perspective, given where we are in interest rates in India, we don't see any sharp decline come through in terms of rates. Thankfully, rates in India have not pierced the kind of levels that we are used to. We are back to pre-pandemic kind of rates, so it's sort of a stable scenario. But I would actually argue that this is advantage large caps, particularly if the global environment gets tighter in terms of money, as opposed to small and mid caps, which come further down the chain. Which mid caps are attractive? We've always said this. There are some companies where market cap may qualify them as mid cap, but in terms of their operating parameters and fundamentals, they are similar to large caps. Okay. Those are the mid caps that we would feel a lot more comfortable.
Okay. Well, I'm going to ask you an unfair last question. What kind of highs do you think in 2080 is possible? Do we see, somewhat 2080 that is, will we see 22, 23,000? What are you looking at?
Well, I'm too old to give forecast, Latha, so I will pass on giving forecast, but I will certainly forecast good times for the country and, share my hopes and, good times for everybody and festive cheer. I think as long as we can keep that, I think as a country, we are making great strides, and that's what is most important.
Oh, that's a great way to end this conversation. Thank you very much, Vetri, and wish you and yours a very happy Diwali. Well, on that note, it's time for a break. Chartbusters up next.